To get into the spirit of this lecture, I want you to imagine that you've been put in charge of investing a big pool of money, say a few $1,000,000, and that amount includes more than a little of your own money. Because you're in charge of investing this money, you have to make all the investing decisions yourself. You decide who to lend money to, what stocks to buy, and so on. And you have to negotiate the terms of all the contracts yourself, too. So you have to decide what interest rate you'll charge each borrower on the loans you make, and you'll decide what price you're willing to pay for the other assets you'll invest in. Suppose you decide to devote at least part of the money into making loans to small businesses, since you've heard that they can have really high returns. So you put the word out that you have money to lend, and instantly a long line of entrepreneurs appears at your office door. I'm at the head of the line. So I burst in and I say, I've got a fantastic new snack concept involving peanut butter and coffee. I need to borrow $1 million to get moving on it. How soon can you write me a check? I'm sure you have all kinds of questions for me, starting with, who are you? And indeed, you'll want to find out a lot about me and about the project I'm proposing to borrow money for. And even if you agree to make that big loan to me, you're going to still have to write a lending contract that protects your interests by ensuring as much as you can that I'll do what I said I'd do with the money and that I'd pay back that loan on time. Now, if you think that getting enough information to be able to make a loan is a hassle, well, you're right. But investing in other assets requires just as much information if you want to make good decisions. To see this, again, put yourself in the position of the investment manager. And this time, suppose you want to invest another part of your savings in the stock market. So put the word out that you're interested in buying stocks, and once again, a huge line of people appears at your office door who have stocks they want to sell you. As usual, I'm at the head of the line. I burst into your office and say, have I got a stock for you? It's called Liberty Operating Systems Research, LOSR. They do, operating systems research. I've got 1,000 shares that I'm willing to sell you for $100 each, but you got to buy them right now. Again, think about what your questions for me might be. The first one might be, is this company for real? And if it is, do they really make any money? And what's my connection to it if I'm trying to sell you the shares? Would it matter to you if I was, say, the CEO of Liberty Operating Systems Research? Well, it should. I've given you these examples to show you that nobody makes a single move in the financial markets without first gathering and analyzing a lot of information. Hopefully, they also get you thinking about the types of information that people need to have when they make and trade financial contracts. One thing I want to make sure that you notice is that we need information not just about the loan we're making or the stock we're buying, but we also need information about the people we're dealing with. This human element in making and trading contracts is what makes financial markets so fascinating and challenging. When it comes to writing and trading financial contracts, what we don't know turns out to be just as important as what we do know. Economists say that information is imperfect, but in practical terms, what they mean is that it's downright scarce. This scarcity of information is a fundamental and permanent feature of the financial markets. Not only is information scarce, but it's unevenly distributed. That is, everyone has a different set of information in their heads, and it differs both in quantity and in quality. Keep in mind that information refers not only to the facts that you know, but also to the conclusions and opinions that you draw from those facts. So even when two people know the same facts, they may reach very different conclusions about what those facts imply. Economists use the term asymmetric information to describe this phenomenon. In just about every financial transaction, there's asymmetric information. In other words, everyone is working with different information. Of course, a lot of the information may overlap, especially when it comes to facts, but it's almost never the case that everyone's information is identical. So asymmetric information is, like scarcity of information, a fundamental and permanent feature of the financial markets. The scarcity of information and its uneven distribution profoundly affect the financial markets. To get a feel for the impact of imperfect information on how we make and use financial contracts, Let's think about what financial contracts would look like if there were perfect information, or well, almost perfect information. Let's assume for a moment that we don't know exactly what will happen in the future, but we know everything that could happen. Also, let's assume that we know every relevant detail about the past behavior of the economy and everyone in it. And let's assume that we can perfectly and costlessly observe any action or decision that someone makes that's relevant to our financial transaction at any time before or after we sign the contract. In other words, let's assume that everyone knows everything about everyone else, at least everything that's relevant to writing and enforcing a financial contract, and that we can always see what everyone is doing. We all have the same knowledge of the workings of the economy, and we know everything that could happen in the future, though we don't know which of these things will happen when. In this world, with its nearly perfect information, we could write financial contracts that are basically perfect. In these contracts, we would spell out everything that could possibly happen that's relevant to the financial transaction, and we'd specify what each party in the contract was obligated to do in those circumstances. And we'd include a set of penalties for not doing those things. Now, since we're assuming that we know everything about each other, we can design penalties to give everyone the right incentives to live up to their promises. And we can perfectly observe what people actually do, so enforcement of the contract is guaranteed. Sitting down and writing these contracts would be tedious, really tedious, but that would be the only hard part about finance. Again, to make this a little more concrete, let's go back to our examples of the business loan and the stock trade. First, if we could write down the perfect business loan contract, it would require the borrower to put in sufficient amounts of specific kinds of effort that are required to make the project successful. And it would set out penalties for slacking off or doing other things that would hurt the chances of success. Again, we could do that because of our assumption that we can perfectly and costlessly observe everything the borrower does after she takes out the loan. The interest rate on the loan would perfectly reflect the risk of the project's profits, since everyone agrees on everything that could possibly happen to the project's profits, and everyone can verify what actually does happen. Similarly, if we consider the sale of stock in this perfect world, we could find a price for the share that perfectly reflects its value. Everyone would have the same understanding of all the things that could happen in the future and what they would mean for the value of the company. So we'd have no problem finding a price that we could all agree on. And it wouldn't matter at all if the seller of the share were the CEO, since the buyer would have all the same information about the company as the CEO does. Well, now let's think about what we really do know and how this affects our ability to write and trade financial contracts. First, we don't know what will happen in the future. Not only do we not know what will happen next, we can't even guess everything that could happen. This in itself makes it a lot harder to write good contracts. And then there are all the differences in information between people. Since no two people will have the same facts and opinions about a project or a company, or the economy for that matter, it's much more difficult to get people to see eye to eye on the value of a stock or the appropriate interest rate to charge on a loan. In addition, we usually don't know very much at all about the person on the other side of the bargaining table, beyond what they tell us. And even then, the person may not be completely honest. Finally, consider enforcement. In the real world, once we make an agreement, it's very expensive and in many cases impossible to monitor what the other person does. And even when we do observe a violation of a contract, it may be expensive and time-consuming to try to enforce the contract. Given all these problems caused by imperfect information, you may think it's a wonder that we have any financial activity at all. Well, it really is a testament to the cleverness and adaptability of humans that we're able to overcome these problems and create financial markets that usually work pretty well. And indeed, the process of writing and trading financial contracts does succeed precisely because people have invented mechanisms and practices that mitigate the fundamental information problems in the financial markets. In fact, one of the 6 basic jobs that the financial markets do for us is to deal with these information problems, both in the financial markets and in other markets as well. You may remember from the first lecture that we introduced the 6 jobs that financial markets do, and here's the 4th job, which is mitigating information problems. What I'm going to do in much of the rest of this lecture is to discuss the worst information problems and show you how some of the remedies are built into the process of writing and trading financial contracts, and are often written right into the contracts themselves. Now notice that I keep using the word mitigate rather than solve. The information problems that we'll learn about in this lecture can't be completely resolved, and in many cases they still cause a lot of trouble in the financial markets. That's because the underlying causes of information problems, the scarcity and the uneven distribution of information in the economy, are themselves impossible to fix. Also, the mechanisms that we use can only do so much. I'm going to focus our discussion on problems caused by asymmetric information, the uneven and unequal distribution of information across the parties in a financial transaction. Economists have identified and described 2 main types of problems that are caused by asymmetric information, and I've hinted at them already. Now we'll learn about them in more detail. The first of the 2 main asymmetric information problems is called adverse selection. The name sort of sounds like natural selection, which you probably know from the theory of evolution, and it refers to a similar process of selecting or favoring members of a group who have certain characteristics. In natural selection, species who have characteristics that make them better suited to their natural environment are favored for survival. But in adverse selection, people who have characteristics that are not well suited to the demands of the market are actually favored by the economic situation. And when that happens, it can destroy a market. Adverse selection is also called the problem of hidden type, as in hidden identity, or the problem of counterfeiting. The idea behind adverse selection is that some important characteristic of a person, such as their trustworthiness, for example, is known to the person, but it's at least partially hidden from the rest of the world, and so it can't be observed directly by anyone else. So we have asymmetric information. I know whether I'm trustworthy, but you can't tell for sure whether I am, and you may not be able to find out with any certainty. Adverse selection becomes a problem whenever this hidden characteristic differs between people and is important for some economic outcome. Suppose there are 2 types of borrowers. Good borrowers, who take their financial commitments very seriously and always try their hardest to repay their loans, and bad borrowers, who don't take their financial commitments seriously and don't try all that hard to repay their loans. And suppose that each type of borrower knows what kind of borrower they are, but nobody else can observe what type of borrower they are. Think about the possibility this creates. If I'm a bad borrower and I say so, I'll either never get a loan or I'll have to pay a really high interest rate on it because I'm a bad risk. But because nobody can observe my type, I could try to pretend to be a good borrower, at least for as long as it takes to get a loan, and not only get a loan, but get one on the same favorable terms as the good borrowers do. Well, clearly, I'll be better off by pretending to be a good borrower. And there's the problem. In the financial markets, low-quality borrowers will pretend to be good quality borrowers, and they'll try to trick lenders into lending to them. Now, the lenders are fully aware of this problem, so what do? Well, one possibility is to try to adjust the interest rate on the loans they make. If some potential borrowers say they're good borrowers, when in fact they're bad borrowers, then this will raise the average risk of the loans I make. Suppose, just for the sake of an example, that I plan to charge good borrowers an interest rate of 5% and bad borrowers an interest rate of 20%. And I believe that about half of all the borrowers out there are good and half are bad. Well, that means that out of a group of 10 borrowers, 5 would be good and 5 would be bad. Why don't I just charge an average interest rate of 12.5%, since this will give me the same average return as if I charged each one the right rate based on their true type? Well, if lenders did that, here's what would happen. The good borrowers would see the interest rate and say, 12.5%? Forget it. I don't want such an expensive loan. But all the bad borrowers would say, hey, 12.5%, still better than 20. Sure, I'll take the loan. So the good borrowers would stop trying to borrow, and only the bad borrowers would keep coming to the lender. This would be a disaster for the lenders because they'll lose money by charging an average interest rate that's too low to compensate for the true risk of all their borrowers. Hopefully, now you can see where this name of adverse selection comes from. If the lender raises the interest rate charged on the loans, the good borrowers will leave, and only the bad borrowers will still want to borrow, which effectively selects the bad borrowers. So one of the things we see in the lending markets is that lenders don't raise their interest rates up too high because this creates adverse selection problems. If lenders can't use the rate on the loan to compensate for adverse selection, what do? First, since the underlying problem is that the lender has trouble telling whether a potential borrower is a good borrower or a bad borrower, the lender will invest resources into trying to gather better information. In other words, the lender will try even harder to try to tell the borrowers apart. We see the result of this every time we apply for a loan. Perhaps you've noticed the tremendous amount of information and paperwork that goes into applying for a mortgage, for example. This is the lender's attempt to overcome the adverse selection problem by attacking the ultimate root of the problem, the asymmetric information. Even with the most advanced tools used to screen borrowers, and we'll learn all about credit analysis in a future lecture, by the way, it's still impossible for lenders to tell the good borrowers from the not so good borrowers all the time. But lenders have other tools as well, and these tools rely on a different strategy. Instead of trying to get more information, the lenders can try to create incentives for borrowers to reveal their true type to the lender. A very common incentive tool is collateral. Collateral is something of value that a borrower pledges to give to the lender if the borrower defaults on a loan. For many loans to individuals, the item being used as collateral is the same thing that the loan is being used to purchase, like a car or a house. For example, when you borrow the money to buy a car, the car is usually pledged to the lender as collateral. In business lending, many different things are used as collateral: the company jet, a factory, or other securities owned by the company. The idea behind collateral is that the borrower will lose the collateral if they can't or won't pay back the loan. In other words, it makes sure that the borrower has something to lose if they default on the loan. Economists call this risk sharing, but a lot of people call it having skin in the game. Using collateral won't bother good borrowers because they intend to pay back the loan in full and don't intend to lose the collateral. But requiring bad borrowers to post collateral will discourage them from taking out a loan. Because they aren't as serious about repaying, they would probably lose the collateral, and so they won't be interested in taking out the loan. Down payments are also often used together with collateral. A down payment, of course, is the part of a large purchase that you pay for out of your own pocket. For example, it's common to make a down payment of 10% on a car purchase and borrow the remaining 90% of the price of the car. It's essential to require a significant down payment from a borrower whenever their collateral is the same thing that they bought with the loan that they took out. Otherwise, the incentive effect of collateral just goes away. This is why all those no money down mortgages that were offered during the housing bubble between 2003 and 2006 were so significant. Borrowers literally had nothing to lose by defaulting, which they did in record numbers when the housing market turned down. Adverse selection is one of the defining problems of making loans. Everyone wants to pass themselves off as a good borrower. But this problem isn't limited to lending. It's also a huge source of fraud in the financial markets. Since the advent of the internet and online financial services, a tremendous adverse selection problem has been created by so-called internet phishing. That's phishing with a PH. If you have an active email account, it's almost certain that you've witnessed this adverse selection problem, though hopefully you didn't become one of its victims. In internet phishing, people send out emails pretending to be some financial institution like Citibank. The email says something like, "Dear account holder, we need to verify your account information for our own security check," or something like that, and prompts you to go to a website and enter all your account information. Once you enter your information, the sender of the email, who is not Citibank, tries to use the information to withdraw all your money from your Citibank accounts. The hackers who operate internet phishing scams count on their ability to mimic the look of an email from a real bank, and your inability to tell a real email from your bank from a fake email sent by a hacker. The hidden type problem. That's the essence of the adverse selection problem. The second main type of asymmetric information problem is known as moral hazard, also known as the hidden action problem. You may recognize the term moral hazard from the world of insurance, and that's a good place to start our discussion of this problem. Ever since the creation of insurance, people have noticed that once someone is covered by an insurance policy, they become less careful. For example, people who have automobile insurance don't drive quite as carefully as those who don't have car insurance. And the reason is simple. It takes a lot of effort to be really careful. Why should I put all that effort into being careful when the insurance company will pay for my accident? The key is that the insurance company can't observe what you're doing at every moment, and they can't really measure your effort very well even if they were able to watch you all the time. This hidden action, which benefits one party in a financial transaction at the expense of the other party, is the essence of moral hazard. The name moral hazard, by the way, refers to the fact that it's up to your moral character to keep being as careful as you would have been without the insurance. We'll learn more about insurance in a future lecture, but moral hazard and its hidden action problem are common features in many other financial relationships. For example, moral hazard is a big problem in lending. One classic example is the so-called asset substitution problem, and it goes like this. Suppose I'm a borrower applying for a business loan. I tell the lender I'm going to use the money to fund a low-risk project that has a high probability of paying off the loan in full, but it won't generate the most exciting profit for me. I show the bank the numbers for this project, and they like the safety and reliability of that project and agree to make the loan. Once I have the money in my bank account, though, I have an incentive to use it to fund a different project, one that has higher risk and a lower probability of earning enough to repay the loan. But if it does work, I make a really nice profit. Because the lender can't observe exactly what I do with their money, that's the hidden action, I can go ahead with the riskier project, and if it fails, I tell the lender that I had some really bad luck on the safer project. Again, the lender is completely aware of this danger, so the lender will try to take steps to lower the chance that the borrower will take advantage of them in this way. One way, as usual, is to try harder to monitor the borrower. In fact, the lender will often require the borrower to give the lender periodic updates about the business and how things are going. If the news doesn't look good to the lender, they reserve the right to require the loan to be repaid in full and immediately. In other words, they can call in the loan. Incentives also play a role in limiting this behavior. As in the case of adverse selection, lenders find that borrowers who have more to lose will resist the temptation to engage in asset substitution. So collateral and down payments also have important incentive effects to mitigate the moral hazard problem. Another strategy that lenders will use is to lend for only short periods of time. If the borrower proposes a 5-year project, for example, the lender may only lend for 2 years, but promise to make another 2-year loan if the borrower behaves well. Because the borrower wants to keep the project funded, they have a big incentive to do what they promised rather than playing the asset substitution game. You may notice that this strategy sounds a bit like the strategy of requiring the borrower to give periodic updates to the lender. And you're right. The threat of not renewing a loan, coupled with the increase in information, work together. The lender gets some information from the borrower while the loan is being paid back, and then when it's time to renew the loan, the lender can take a closer look at the borrower's finances and their recent activities. The asset substitution is just one way that the moral hazard or hidden action problem appears in the financial markets. There are many other ways as well, and we'll learn about some of them later in the course. So far, the picture I've painted about the role of information in financial markets seems pretty grim. Information is scarce and is unevenly distributed, which makes writing, trading, and enforcing financial contracts difficult, to say the least. And despite our best efforts to cope with the problems caused by asymmetric information, we'll never be able to completely solve them. But even though all these things are true, there's actually a positive side to the lack of information in the financial markets: opportunity. People who have better information have a competitive advantage in the financial markets. If you're a lender, you can make better decisions about who to lend to and at what interest rate if you have better information about borrowers. If you're an investor, you'll have a better idea of what a stock is really worth if you're better informed about companies and the economy. In other words, information has tremendous value in the financial markets, so people are always trying to uncover new information and use that information to help them make profits. Now, I'm not just talking about trading on insider information about companies, though of course that does actually happen. What really goes on in the financial markets is that people are constantly looking for new facts and, better yet, trying to figure out what these facts mean for borrowers, lenders, and traders. When some clever person finds new information or figures out a better way to piece together existing information, they'll put that information to work in the market, lending or borrowing, buying or selling. If their information really is better, then they'll be rewarded by making more profits than their competitors. This process has two important consequences for the financial markets. First, the financial markets discover or really create a huge amount of information as an essential part of their normal business. Some people go as far as saying that information is what financial markets actually produce. And they have a point, but I don't think they're quite right. The point of the financial markets, after all, is to perform the 6 essential jobs that we learned about in the first lecture in this course. But in order to do those jobs, the financial markets need a lot of information. We can think of information as a critical input that goes into the production of financial services. And financial service providers generally make this input themselves rather than buying it from somewhere else. The second consequence of this process is that in order to profit from the information you have to reveal at least some of it to the market. Whenever you take some action in the financial market, buying or selling, borrowing or lending, your action says something to the market about what you know or what you believe. And your actions also have an effect on the prices of financial assets and financial services. So all this information that is created in the process of supplying financial services does find its way into public knowledge, at least eventually. In a very real sense, the markets are correcting the scarcity and uneven distribution of information that we learned about earlier in the lecture, or at least they're trying. Again, the market can't even come close to completely solving these problems, so we shouldn't expect the financial markets to ever be perfect. In fact, as we'll see throughout the course, information problems play a major role in just about every financial problem and crisis. Still, the financial markets really accomplish a lot despite the scarcity and uneven distribution of information. Well, this lecture completes our introduction to the financial markets. We've learned about the main jobs that financial markets do for society and visualized how money flows through the markets as it carries out these jobs. And now we've just seen how information affects everything that happens in the financial markets. These basic ideas will really help us understand the details of how the financial system works as we progress through the rest of the course. Speaking of details, now we're going to move on to a unit that takes a detailed look at borrowing and lending. I want to talk about this next because it's one of the main ways that most of us are involved in the financial markets. I think it's really important for all of us to feel comfortable with the borrowing process so that we can be more confident and proactive consumers of loans. Plus, as we learn about all the different ways that businesses borrow from households, we'll get better acquainted with some of the basic financial instruments that we can invest our savings in. We'll start the unit on borrowing and lending by learning what information lenders really consider when you apply for a loan and how they use that information in a process called credit analysis. A lot of people and advertisers seem to think that the only thing that determines whether you get credit is something called your credit score. Is that true? Where does your credit score come from anyway? Well, in the next lecture, we'll find out.